Hello everyone, this is Sridharan from Wallet Wealth. The investors are looking at different products in their basket to look at different returns. So when we are talking about the traditional investments, everybody having a thought about whether to invest in fixed deposit or to invest in mutual funds. Let us see the difference and the advantages of both the products. See, basically when we are talking about investing in a traditional product like fixed deposits, in fixed deposits, ideally, one should have certain portion of their investments in fixed deposit, but not all the investments in fixed deposit. The reason being, the fixed deposits are providing about 6 to 7% interest. So on a yearly basis. So when we are talking about 6 to 7% interest, the inflation itself is about 7%. On a long-term average basis, the inflation is at 7%. And when you are getting a return of 6%, so you are actually, getting a return which is 1% less than the inflation. That's number one. Number two is whatever the returns that you are getting from fixed deposits are taxed at your nominal rate. Assuming you are under 20% tax slab, so the return of 6%, you have to pay 20% tax on it, which is nothing but 1.2%. So 1.2% minus 6%, which is 4.8%. So you are getting hardly 5% return versus the inflation, which is 7%. By unknowingly, you are actually, eroding your capital. Does it mean that, all the money has to be put into mutual funds? We will see what is the advantage of investing in mutual funds. See, when it is coming to mutual funds, basically they will be investing in the economy. They have different types of mutual funds available, maybe equity mutual funds and then the debt mutual funds and then the kind of hybrid mutual funds and then the gold mutual funds. So various asset classes can be invested by using the mutual fund as a product. One. Second is when we are talking about equity. So when the economy does well, the equity mutual funds does well, and when the economy is not doing well, the mutual funds may be not doing well because of the economical impact, because it has got an economical impact. So by the same time, when the economy does well, it provides a superior return than the fixed deposit. But if you look at from the long-term average, we are talking about the last 40 years, 45 years, one can expect 12% to 15% return on mutual funds. We are not talking about 12 to 15%, even if we get about 12 to 13% return on a mutual funds, which is basically beating the inflation of 7%. And then the taxation on mutual fund is very, very less. The long-term capital gains on mutual funds, if you are falling under any tax slab, it is only at 12.5%. So removing 12.5% return on 13%, which is equivalent to, you will get about 11.75 to 12% return post-tax is easily achievable over a long period of time. When we are talking about long period, it is about 5 years, 7 years, 10 years is the long period one has to stay invested in mutual funds to get this kind of a return. So this is the expectation on mutual funds, which will provide you a better inflation adjusted and tax adjusted return, wherein the FD is providing you not the inflation adjusted and tax adjusted return. So which is actually, slow and steadily we are taking the risk of eroding the capital against the inflation, wherein here at the short term, your capital erosion, the capital erosion will be there, but it is notional unless and until you realize it. But on the long term, the capital erosion might be negligible and can be avoided by staying invested for long term in mutual funds. Thank you.